So financial markets the world over are on edge. The implications of this weekend's resounding no vote in Greece are now sinking in. It wasn't quite the initial Lehman moment that some had feared, but the reaction of investors is as clear as the referendum result itself. And all now hangs on whether Europe, i.e. Germany, is prepared to rescue Greece on its own terms. The ASX fell sharply at the open, wiping more than $20 billion off the value of shares. It's finished off those session lows, though, down 1.1%. Across Asia, Tokyo's Nikkei and Hong Kong's Hang Seng were both seeing red. In Shanghai, though, it's now around flat after a tumultuous day following authorities' attempts to prevent a crash. And we'll have more on that story shortly. And risk aversion in the market saw the Australian dollar dumped overnight. At one point, it hit a 6-year low against the greenback. In a moment, we'll be live to London to discuss where Greece and indeed Europe goes from here. But first, here's finance correspondent Philip Lasker.
It's the one thing markets detest, and right now they have it in truckloads. Uncertainty.
Sol's down, Nikkei's down.
Markets in Asia, the first to respond to the emphatic Greek referendum result, are even uncertain about the level of concern.
I'd have to describe our mood as a professional investor is at the moment is very wary and a bit apprehensive without being anything like tremendously concerned.
Equity markets throughout the region were generally lower. Countries with good credit ratings like Australia and Germany saw bond rates fall. Gold went up and the Australian dollar has tumbled to a 6-year low below 75 US cents.
So it's a very classic risk-off type move and a move into safe haven type assets.
But there are hopes that the turmoil surrounding Greece will be kept in proportion to its tiny economy, with the losses restricted to those with direct exposure.
The Greek situation does not have the potential to turn into another GFC. It's just simply not big enough.
We think the next 48 hours are quite key here. There'll be a number of important meetings, particularly amongst the Eurogroup finance ministers, and really I think what's key now is the willingness of both sides to negotiate over a third package.
Of greater concern to Australia is the stampede of new investors to China's share market as it more than doubled in a year. This weekend, China moved to shore up the market, freezing IPOs and instructing fund managers to buy shares.
I'm having a bit of trouble, as a lot of investors are, in trying to work out what that actually means. Was the run-up real? So has the decline been real?
Efforts to prop up the market were followed by measures a week ago to stimulate the economy by freeing up more money for banks to lend.
I guess what we often say is watch the policy action of the Chinese authorities, not the data, because that tells you a lot more about the underlying economy.
The Reserve Bank will meet to consider interest rates tomorrow amid this uncertainty, and it's not expected to move. But China's weakness, slumping commodity prices and a delay in the raising of US interest rates might see them call for an even lower dollar.
All of these developments tell you that 75 cents is probably not a level that the Reserve Bank is happy with, that it needs to be lower than that.
More like 70 US cents.